for you. Mr. Munger, at last year's shareholder meeting, you stated that you didn't feel that the concept of the cost of capital made true economic sense. Would you explain why you felt this way and what you would do to replace it with anything? My second question is to Mr. Buffett. You've stated the importance of an occasional big idea. How were you able to, in fact, tell when you had a big idea? And my third question, Mr. Buffett, you have talked about the importance of the franchise and sustainable competitive advantage. Companies like Kellogg and Campbell Soup are companies that most people would have said had those qualities. However, over time, those qualities were lost as a result of a change in consumer taste. What gives you confidence that the same things won't happen to Coke or Gillette?
Charlie?
Well,
Cost of capital.
Cost of capital first. Obviously, considerations of cost are important in business. And obviously, opportunity costs, which is a doctrine of economics, really a doctrine of lifesmanship, are also very important. And we've always had that kind of basic thinking. Of course, capital isn't free. And of course, you can figure cost of capital when you're borrowing money, or at least you can figure cost of loans. But the theorists had to develop some theory for what equity cost. And there they just went bonkers. They said if you earned 100% on capital because you had some marvelous business, your cost of capital was 100%. And therefore you shouldn't look at any opportunity that delivered a lousy 80%. That is the kind of thinking which came out of the capital assets pricing models and so forth that I've always considered inanity. What is Berkshire's cost of capital? We have this damn capital. It just keeps multiplying and multiplying. What is its cost? You have perfectly good old-fashioned doctrines like opportunity cost. You know, at any given time when we consider an investment, we have to compare it to the best alternative investment we have at that time. We had perfectly good old-fashioned ideas that are very basic to use, but they weren't good enough for these modern theorists. So they invented all this ridiculous mathematics, which concluded that the companies that made the most money had the highest costs of capital. Well, all I can say is it's not for us. Now, the other half of that question I leave for Mr. Buffett.
Yeah, what you find, of course, is that the cost of capital is about 0.25% below the return promised by any deal that the CEO wants to do. Very simple. We have three questions on capital with capitals around, and leaving aside whether we want to borrow money, which we generally don't want to do. And one is, does it make it more sense to pay it out to the shareholders than to keep it within the company? The sub-question on that is, if we pay it out, is it better off to do it via repurchases or by a dividend? The test for whether we pay it out in dividends is, can we create more than $1 of value within the company with that dollar than paying it out? And you never know the answer to that, but so far the answer, is judged by results, is yes, we can. And we think that prospectively we can, but that's a hope on our part, and it's justified to some extent by past history, but it's not a certainty. Once we've crossed that threshold, then do we repurchase stock? Well, obviously, if you can buy your stock at a significant discount from conservatively calculated intrinsic value, and you can buy it in reasonable quantity, that's a use for capital. Beyond that, then the question becomes, if you have the capital, you think you can create more than $1, how do you create the most with the least risk? And that gets to business risk. It doesn't get to any calculation of the volatility. I don't know the risk in See's Candy is measured by its stock volatility, because the stock hasn't been outstanding since 1972. Does that mean I can't determine how risky a business seed is because we don't have a daily quote on it? No, I can determine it by looking at the business and the competitive environment in which it operates and so on. So once we cross the threshold of deciding that we can deploy capital so as to create more than $1 of present value for every dollar retained, then it's just a question of doing the most intelligent thing that you can find. And, that is the cost of every deal we do is measured by the second best deal that's around at a given time, including doing more of some of the things we're already in. And I have listened to cost of capital discussions at all kinds of corporate board meetings and everything else, and I've never found anything that made very much sense in it, except for the fact that it's what they learned in business school, and it's what the consultants talked about, and most of the board members would nod their head without knowing what the hell was going on. And that's been my history with the cost of capital. Now,